Good morning. You are watching live market outlook for Tuesday, 7th of February 2012, prepared by Windsor Brokers. Greek problem is back to the focus in the Europe as resistance to the strict conditions attached to a bailout fund are now delaying again the conversation between the Greece and their private bondholders, and the resistance to the strict conditions sapped the recent momentum in markets, spurred by hopes the global economy is improving, and the euro was actually lower during the overnight session on renewed fears of messy debt default. However, this morning euro is back to the strength and bouncing above 131 zone where it hovered during the Asian session. The markets are recovering reversing after the latest rally from last Friday's NFP data, when dollar rallied across the board and pushed the euro and sterling lower, as well as commodities. Now dollar is raising its gains, while euro, despite current uncertain situation in Greece, is back to strength this morning and moving above 131.00. Sterling also regained the 158 handle after dipping yesterday to 157.30 zone, the support zone, while dollar is again lower against the Japanese yen, increasing fears of another failure of the upside rally after the pair hit 76 support, where temporary ground was found. Dollar Swiss also lower from yesterday's peak at 92.61. Loss of 92 handle now is threatening a retest of near-term base at 91 zone, while gold is recovering after a strong 2 days fall from 1763 that found ground just above our initial support at 1700. The Australian dollar was sharply higher this morning after the Central Bank of Australia held rates steady in surprise, unexpected move, as the widely expected cut of 0.25% failed to happen, and the Australian Central Bank kept the rates at initial 4.25%, with the Aussie dollar rallying against its US counterpart, breaking above 108 level and hitting so far 108.21, extending the broader uptrend of the Aussie dollar from the levels below the parity. The Greek leaders are now facing the crunch talks actually today to agree on unpopular reforms and to secure 130 billion euros, equivalent to approximately 170 billion US dollars bailout, and avert possible chaotic debt default, which could threaten its future in the Eurozone. As mentioned, the initial talks failed yesterday, and the leaders are now caught between their increasingly frustrated partners in the European Union for failing to pass the reforms quickly, and workers who went on strike again today to protest against the austerity measures. Eurozone officials say the full package must be agreed with Greece and approved by Eurozone and the European Central Bank and the IMF before the February 15th to allow time for complex legal procedures involved in the bond swap to be completed in time for a March 20th bond redemption. In some Eurozone, that includes Germany and Finland, parliamentary approval is required to raise the bailout money. In Paris, German Chancellor Angela Merkel yesterday expressed the exasperation among Eurozone leaders at seemingly endless arguing in Athens that has yet to produce a definitive acceptance of the austerity and reform demand by lenders. Now, this remains focus for today. We are again going to closely watch to see. However, the euro is, as I said, finding some strength after the European session opening, and its recent rally above 131 is looking for a stronger recovery. For now, more of this we'll have on our technical part. Now, brief look on today's calendar. As mentioned, the Australian Central Bank in an unexpected move stayed pat at 4.25 rates compared to the widely expected cut by 0.25% and forecast for 4%. Japanese leading indicators improved compared to the previous month release and compared to the forecast for today. 94.3% was today's release compared to 93.7 previous month, and 93.9 forecast for today. German industrial production is due at 11 o'clock GMT, and the slight improvement is forecasted for today. Minus 0.1% is today's consensus compared to minus 0.6 of the previous month. Across the ocean, Canadian building permits are due at 13:30 GMT. A monthly release, 0.2% forecast increase in the building permits compared to the draw of minus 3.6% in the previous month. Fed German chairman Ben Bernanke is due at 1500 GMT, and he will testify. And that would be all for today's economic indicators that are due to be released during the day. Now let's take a look on the markets and see the latest movements in past 24 hours. The euro remains within the range, but the tone is still skewed towards the downside. A succession of lower highs from 132.32, the main barrier in the near term. It keeps the downside still vulnerable. Yesterday's dip and fresh weakness tested the 130.25, which is our key near-term support and the near-term range floor, where the pair found the temporary support and bounced sharply higher. This morning, price action sees the brief break above the main bear trend line of 132.32, which is initial barrier at this point. Studies on the 1 hour are turning positive now, and looking for possible further extension higher towards next the 131.66. The intraday high of last Friday was tested so far, ahead of more significant barriers at 132 and 132.16, the high of 1st of February. Basically 132.32 is a strong barrier zone, and the clearance of this barrier is required to confirm the double bottom seen on the 4-hour chart at 130.25 and resume the short-term uptrend from 126.22. On the upside, also this 132.32 marks 38.2 Fibonacci retracement of the short-term downtrend from October, end of October, 142.46 high to 126.22 low of 13th of January 2012. Immediate dynamic resistance above this comes at 133.33. Ahead of this, we have 133 as round figure resistance, and then 90 days moving average on the daily chart. On the downside, as mentioned, the downside remains still vulnerable as long as 132 minimum keeps the upside limited, and possible loss of 130.25, our key near-term support, to open way for further retracement of the up move from 126.22 to 132.32, and focus Fibonacci level at 130.00, which is also the round figure support, loss of which to further weaken and open next array of supports at 129.30 zone, low of 25th of January 2012, and 50% Fibonacci retracement with the break below this level to end the short-term recovery of euro-dollar and resume the losses towards the latest low at 126.22. The cable is still within corrective consolidative range after hitting fresh high at 158.81 on 1st of February, with fresh low at 157.30 hit yesterday, just ahead of our strong support at 157.05 low of 1st of February, and 50% Fibonacci retracement of the latest upleg from 155.30 to 158.81. The near-term outlook is rather neutral to negative as the pair continues to move slightly lower, moving under the bear trend line drawn of 158.81 with the 157.30, 157.05 offering good support for now. Moving within this range requires a break either side to direct the near-term price action. On the 4-hour charts, studies are weakening, and this might suggest further easing as long as trendline resistance currently at 158.38 holds the upside. This morning, a recent trip above 158.00 has stalled just ahead of the trend line, and the break here is actually to signal further recovery and open next barrier at 158.60 ahead of key barrier at 159.00. Successful break through these levels would open on the upside 159.00 is around the figure resistance, and then the very important 200 days moving average on the daily chart currently standing at 159.41. On the broader picture, the studies are still in the positive mode, however, slightly overextended as the RSI is moving just under the overbought border, and possible further easing is not ruled out at this point. On the downside, 90 days moving average currently at 156.77 is holding the downside, with the 20 days moving average currently crossing above 55, giving some more positive signals. Basically, on the larger time frame, we can see that the price action is currently limited between 290 days moving average. However, more positive studies keep the upside slightly more in focus, especially in light that the pair recently broke some critical barriers at 157.70 and 158.00. November to December range ceiling, and the 61.8 Fibonacci retracement of the down move from 161.64 end of October high to 152.33 13th of January low. The dollar yen is near-term price action is again in a narrow range in directionless mode, as the pair usually does after the certain stronger moves. The latest rally from 76, where temporary base was found, hit so far 76.79. This was the high of yesterday, and the downside remains limited for now with our key support 76.50, previous strong support, then reverted to resistance, and now is back to support. A very important level, better seen on the daily chart, that held the downside contained for approximately 3 months from November, with several attempts failing to break lower and keeping the pair within the range of 76.50 and the 78.30 on the upside. Holding above 76.50 keeps potential for further extension higher, especially that near-term studies are turning positive, as 20 days moving average currently at 76.42 supports the latest rally. However, break above recent high at 76.79 and Fibonacci level 38.2% at 76.86, as well as break above 77 as the figure resistance, and the 77.13, 50% Fibonacci retracement. I would say the most significant are these two Fibonacci's at 77.15 and 77.40 to confirm the near-term bottom at 76 and open way for a stronger recovery towards 78.27, recent high posted on 21st of January. Some comments released yesterday, an analysis saying that Bank of Japan might react in case of dollar yen dipping down to 75. Now this is the downside. The limit has been slightly moved lower. Okay, this is speculation from one of the big banks, but most likely action, the Bank of Japan would take action in case of the pair dipping below the previous all-time low and explore levels towards 75 where likely the intervention might happen. In any case, Bank of Japan does not announce their actions unless they happen, so we will see whenever they find it suitable, their action will follow. For now, the near-term dollar yen remains supported, but currently consolidating within 76.50, 76.80 range, with the bias slightly skewed higher as the recent bounce from 76.00 holds a positive near-term tone. The dollar Swiss again is lost traction after yesterday's false break above the recent range ceiling at 92.50 with 92.61. So brief break higher was seen ahead of sharp reversal, keeping the pair within the 91.13, 92.60 range and the directionless mode, as the near-term studies remain rather neutral at this point, as the pair keeps ranging below and above 4-hour 20 days moving average. On the bigger picture, the break of attempt to break below 90 days moving average that currently stands at 91.88 might further weaken the tone, as the daily Bollingers are widening at this point, and immediate threat will be on extension as the pair lost 92 handle, would be threat on 91.13 low and the near-term base posted on 27th of January, ahead of 91.00, 50% Fibonacci retracement of up leg from 85.66 to 95.93, with the 90.00 figure support and 89.55, 61.8 Fibonacci retracement. On the near term, regain a clear break above 92.60 and regain of 93.38. Our significant barrier, a lower top of 25th of January, is required to avert immediate downside risk and confirm the near-term base at 91.13 in order to allow a stronger recovery and keep the downside protected in the short term. Gold near-term price action shows the pair in near-term recovery mode after hitting a fresh low at 17.11 yesterday as a part of three-legged correction from latest high at 1763 when the pair tested our initial resistance high of 2nd of December 2011. The current near-term studies are still in the negative mode, as long as lower top at 1738 of yesterday's intraday low holds the upside protected, and the current high of 1729 is seen at risk of posting another lower top in case of a pair losing higher platform at 1718 overnight lows. Break above 1738 is to signal stronger recovery and possibly focus levels at 1763. On the 4-hour outlook, the studies are still negative, as 1738 also the 20 days moving average along with this highs of yesterday keeps the upside limited. The immediate risk remains on the downside for possible further reversal of the latest upleg from 1650 level low of 25th of January, with loss of yesterday's low at 1711 to focus our key near-term support at 1700 zone, where is round figure support and the 50% Fibonacci retracement of the latest upleg. The wider picture outlook still keeps the quite positive tone, correcting on overbought daily studies, with the 20 days moving average crossing all three larger ones, 255 and 90, and keeping the upside in focus, especially that the gold price recently broke the main bear trend line, and the gains so far stalled just ahead of 61.8 Fibonacci retracement. The latest pullback on the daily chart is seen corrective as long as 1760.92, where currently stands 20 days moving average, holds the downside and contains the dips, and the fresh rally is expected to break above this critical barrier at 1763, also 61.8 Fibonacci retracement, to open a next array of resistances at 1800 zone, which is again figure resistance and the previous high of 8th of November 2011. On the downside, a loss of 1650 zone, the low of 25th of January, and 200 days moving average would risk further easing and might confirm a double top seen on the daily chart. The crude oil continues to trend lower as the recovery from the latest low at 95.43 posted on 2nd of February has so far found good barrier at 98.00, where the gains stalled, and the further easing of there is seen hitting so far lows at 96.37. I would say at the near term the oil price is in the neutral mode, ranging between 96.37 and 97.65, so we're talking about 120-30 points range. However, the wider picture still keeps the negative tone, as the studies are in the negative territory, and the loss of momentum of on 4-hour chart and the current attempt below 20 days moving average brings immediate risk to the downside, with the 96.37 to come first, ahead of 96.00 figure support and the low of 3rd of February, and the key near-term support at 95.43. On the daily picture, we can see that the studies are turning negative as oil price moves within the short-term channel of 5th of January high at 103.72. With the 90 days moving average currently at 95.78 coming as the first dynamic support. Break of 20 day attempt of 20 days below 55 days moving averages to give a signal of further easing of the oil price, and to possibly open on a break of 95.43 to possibly open our key short-term support at 92.70, 16th of December low. Good luck.